Yes, sir.
Yeah, good evening.
Good evening, sir.
Yeah, sorry for keeping you holding.
Good evening, sir.
All right, good evening. Thank you. All right, tonight we won't waste time at all because we have been on this topic.
Good evening, sir.
Yeah, Sandra, good evening. We have been on this topic for a while and it's very wide topic. Business financing. How can you finance your business? We have solved like 2 questions, but I'm not sure I've solved this question with you. If you look at the group chat,
Sir, your voice is far. Your voice is far, sir. Your voice is far.
My voice is not far. I'm closer to my system. Hello, Matthew. My voice is not far.
It's not far. I can hear him clearly from here,
so
though.
You need to check your device.
Your voice is okay, sir. It's not far.
Thank you. All right. Like I said, we are rounding up on this topic tonight. Business financing. We have solved like 3 questions. 1 calculation question, that is Balama PSC. And we have solved 2 theoretical questions. Now, this evening, I shared a question with the group. Go to the group chat. This question is not available in your study pack. The question is shown on your screen. James Obasi PSC. I'm not sure I've solved this question with your class. I'm not sure I've solved this question. Can somebody confirm that, please? James Obasi PSC. Have we solved this question?
You have not solved it, sir. No.
All right. Thank you. All right, thank you. So please, if you are looking for the question, just go to the WhatsApp chat and pick the question there. The question is also available on the screen. James Obasi PSC. Let's go to this question together. Along the line, we can do a summary of our discussion. All right, I'll read. James Obasi PSC is a medium-sized manufacturing firm making drums. It is considering a 1 for 5 rights issue at a discount of 15% to the current market price of 1 naira per share. Issue costs are expected to be 2 million naira. And this will be paid out of the funds raised. Please note that our issue cost 2 million. This amount will be paid from the money generated from the right issue. It is proposed that the right issue fund will be used to redeem some of the existing debentures at par. Let's explain that. This company is planning to raise additional funds by issuing new shares to existing shareholders. The money generated from the right issue will be used to redeem, that is, repay some of the existing debentures. So the purpose of the money is to repay the existing debentures, to repay the debt. Financial information relating to James Obasi PSC is as follows. Your fixed assets, your current assets, inventory, receivables, cash, your current liability, payables, overdraft. Then we have 12% bond. Please note, your bond is also debentures. You can call it bond. It's also called debentures. Amount 4.5 million. 12% debentures. Next. You have the ordinary share capital. Par value 50 kobo. The price earning ratio of James Obasi is given. Overdraft interest rate is given. Income tax rate is given. Sector average. Debt to equity ratio. And we have the interest cover ratio. Requirement A. Ignoring the issue cost and any use that may be made of the funds raised by the right issue. Calculate A1, the theoretical ex-right price and value of the rights by existing shares. Oh no, undo. Let me just copy. Now let's go to this. Requirement A. Calculate theoretical ex-right price. Just 1 minute, please.
I can't hear him. Just my name.
Requested for 1 minute is coming.
Oh, okay. Thank you.
All right, let's go on with the class. Sorry, I just have a temporary, I don't need to stand up temporarily. All right. Whenever you are asked a question, try to explain to yourself. Examiner says, ignore issue cost and any use that may be made of the funds raised by the right issue. Calculate theoretical ex-right price. Now let's ask ourselves. I believe in this class, we all know the meaning of theoretical ex-right price. That is the expected share price after the completion of the right issue. What we expect the share price to be after the completion of the rights issue. Now, how do we calculate theoretical strike price? We have done this before. Now let's go to the business. I'm trying to pick my pen. Okay. Now, how do we calculate theoretical strike price? Our theoretical X rights price. All right. Need just 1 minute. I don't need to change my. Please pardon me. Where's my glasses? Yeah, let's go on with the class. If you are to calculate theoretical strike price, first get the arrangement. Examiner says right issue. Right issue. 145 at 15% discounts to the market price. Market price of 4 naira. Right. If I'm to interpret this now, 145 for every 5 existing shares, we are going to issue 1 additional share as a right. For every 5 existing shares, we are going to issue 1 additional share as a right. Now, to calculate your theoretical X right price is equal to the item, quantity, price, and value. You start with existing shares.
Jenny, stop now. Close it up.
No.
Please, can you mute?
Shut it up.
No.
Thank you. Our existing share, 5. Price of existing share, current market price is 4 naira. Our new share, 1. Price of new share at 15% discount to 4 naira. Now you are going to discount out of 15%, out of 4 naira, you are going to discount 15%. You are left with 85%. The total price is 100%. If I'm giving you a discount of 15%, that means out of 100%, I'm giving you discount of 15%. That means you are going to pay 85%. You can now calculate price of new shares. Price of new shares is equal to 85% of 4 naira. Please compute. What do we have?
3 naira 40 kobo.
3.4.
3 naira, thank you. 3 naira 40 kobo, or you can say your 3.4. So please, let me explain that again. Some might be wondering, where is this 85% coming from? 3.40. You want to buy a product from me. You have to buy a product from me. My selling price is 100%. And now say I'm going to give you a discount of 15%. Out of 100% minus 15%. That means the price you are going to pay me is 85% of the current price. That will give us 3.40. Remember right issue. Issuing new shares to existing shareholder, usually at a reduced price. Normally the price is 4 naira at the stock market. We are now issuing new shares to existing shareholder at a price of 3 naira 40 kobo. Now calculate your value. 5 multiplied by 4, 20. 1 multiplied by 3.4, 3.4. Add your quantity, 6. Add your value, 23.4. Please don't add price. Now calculate your theoretical X right price. Total value over total value over total quantity. $23.4 divided by 6. Please work this out. What do we have?
3.9.
3.9.
3.90.
3.90.
That is the theoretical X right price. We have shown this before. Now, I also want to show you an alternative approach so that in exam, because Some question might take you to the second alternative. What is the alternative approach? So I put all here. First, number of existing shares. Total number of existing shares. Go to your statements. Examiner says ordinary share, par value 50 kobo, total amount 4 million. If I want to get number of shares, big total value 4 million naira divided by the nominal price. Nominal price is the par value or balance sheet value. 50 kobo per share, that's 0.5. Number of shares in the company currently 8 million shares. Number of existing shares, total number of existing shares 8 million. Total number of new shares, total number of new shares. Examiner say 1 for 5. Get me water, please. 1 for 5. That is, for every 5 shares in existence, for every 5, issue 1 new share as addition. So if I have 8 million shares in existence, how many new shares am I going to issue? 1 for 5. Yes?
1,600,000.
Thank you. That becomes 1/5 multiplied by 8 million. Totaling 1,600,000 shares. You can also now calculate theoretical X right price. Your item, your quantity, your price, your value. Existing shares total. Existing shares 8 million shares. Price is 4 naira. Total value 32 million. New shares. Total 1,600,000 at a price of 3 naira 40 kobo. Total value 5,440,000. Please, you can reconfirm. Total year 9,600,000. Total year 37,440,000. Our theoretical X-right price. Our theoretical X-right price, total value 37,440,000. Total quantity of shares 9,600,000. Please calculate. You are going to get 3.9.
23.4.
It's 3.9.
3.9.
Please go on and check. Your answer should be 3.9. You can either use the first approach,
Yes, sir.
or you can use the second approach. However, this second approach will always help you in subsequent questions. Yes, Matthew.
Sir, that means this second approach now, we are solving using total, while the first approach, we are solving using the units. Could it
Using
be?
what?
Yes.
I said this second approach, we are solving using the total value, while the first approach, we are solving using the unit value.
The first approach, we use unit value. We use total value. Both approaches will give you the same result. But for some questions, you second approach to help you in subsequent questions. All right. We have resolved A Roman figure 1. Next, we have resolved this. Next, the value of the right per existing share. Let us explain this first. Let me add to this. As me, we have 3. This 1, this 2. Let me add to this question. The value of rights per new share. If you have to calculate value of the rights, what is value? Let's explain small. You are a shareholder with a company. The company is now doing right issue. The company is issuing additional shares to existing shareholder as rights. Now ask yourself, what is the value of these rights to me? It means, what do I stand to gain? Of what value is this right to me? What do I stand to gain from this right? So if you are asked, what is value of the right? Value of the right is the gain, the profit from that right. Please, can you mute? Chioma Adedeji, your speaker is conflicting the class. Even Shola. All right. Now, if you are to calculate value of the right per existing shares, A Roman figure 2, value of the rights per existing share is equal to theoretical S right price minus issue price or right price. You can call it right price also. Rights price divided by number of existing shares in a right. I can buy the new share as a shareholder. I can buy the new share for 3 naira 40 kobo. After the right issue, after we have completed the right issue, the share price at the stock market is expected to be 3 naira 90 kobo. This becomes 3 naira 90 kobo minus 3 naira 40 kobo. Divided by, please look at this, number of existing shares in a right. Examiner says 1 for 5. Please don't pick 8 million. 1 for 5. For every 5 existing shares, issue 1 new share as rights. You pick 5 here. 5 existing shares. Now calculate 0.5 divided by 5. That will give you 0.1. That is value right per existing share. I've added one more question. Value of the rights per new share is equal to theoretical strike price minus the right price. Examiner says 1 for 5. For every 5 shares in existence, issue 1 new share. New share 1. Value per new share 0.5. You have calculated value. For every new share the shareholder purchase, the shareholder will make a gain of 50 kobo. For every new share purchase, the shareholder stand to make a profit of what? 50 kobo. Why? For every existing shares, the shareholder stand to make a gain of 10 kobo. You are done with requirement A. We now move to requirement B. Now look at requirement B. But I'm trying to take water. Let's expand this. What alternatives are open to the order of 1,500 shares in James Obasi PSC as regards the rights issue? Determine the effects of each of these actions on the weight of the shareholder. Let's explain this. We have a shareholder, a particular shareholder has 1,500 shares in existence in James Obasi. The company is now doing a rights issue, 1 for 5. The company is issuing new shares to all existing shareholders. One of the shareholders is now having 1,500 shares. Now the question to us is, what are the alternatives open to this shareholder? Can anybody recall? Yes, Matthew.
The shareholder has basically 4 alternatives to decide. First,
All right.
he may decide to take the rights. Then 2, he may decide to take part of the rights and sell part of the rights. 3, he may decide not to take the right at all. 4, he may decide to sell the whole rights.
All right, thank you, Matthew. There are 4 alternatives open to the shareholder. The shareholder may decide to take the rights and buy the new share. That is alternative 1. The shareholder can decide to renounce the rights, reject the rights, and sell the new shares to another investor. That's alternative 2. The shareholder can decide to take certain percentage of the new share and sell certain percentage. That's alternative 3. The shareholder can decide to ignore the rights and take no action. These are the 4 alternatives. Now the question is, on the shareholder's weight. The shareholder decides to take up his rights. What is the impact of this shareholder's weight? If the shareholder decides to reject the rights and sell the new shares on the shareholder's weight, when we say shareholders' weight, it means shareholders' investment value. The value of your investment
Can we hear him?
We
Yeah,
can
I can
start
hear
from
him.
here now. Requirement B. First, calculate the weight of the shareholder currently. Before right issue. Shareholder weight is equal to this shareholder has 1,500 shares in the company, and the current market price per share is 4 naira. That means currently the shareholders' investment value before rights issue, the investment value was 6,000. Now, after rights issue, option 1 or alternative 1. Option 1. The shareholder
Can we hear him?
can decide to take up his right and buy the new shares. This option 1. Now the question now is, if the shareholder take this option 1 on the shareholder's weight, let's look at the impact. Item, quantity, value. To start with the existing shares. Exit 1,500. After the completion of the right, we at the stock market. So, calculation in A1, equal X strike price. What we expect the share price to be after we have completed the right issue. We expect the share price to be 3 naira 90 kobo. Whether new shares or existing shares, all the shares at the stock market will now have a price of 3 naira 90 kobo. Price 3.9. Please multiply. 1.5 multiplied by 3.9.
5850.
Our new shares. Now, 1 for 5. For every 5 shares, this shareholder is entitled to 1 new share. Now, if you have 1,500 shares, how many new shares will this shareholder be entitled to?
300.
300.
Thank you. Now look at the working. If you are not sure, just do 1 over 1/5 multiplied by 1,500. This shareholder is entitled to 300 new shares. And we said after the right issue, the expected share price at the stock market, whether new shares or existing shares, the price is expected to be 3 naira 90 kobo. Now calculate value. 300 multiplied by 3.9.
1170.
1170.
1170. Yes, Clementina.
Okay, good evening, sir.
Yeah, good evening.
I wanted to confirm for these existing shares, is there a reason why I don't know, I must have missed it. Why are we using 3.9 and not the 4 naira?
All right, quick one. Theoretical strike price. What we expect the share price to be at the stock market after we have completed the right issue. Both existing shares and new shares will be combined together. And we calculated that we expect the share price to be 3 naira 90 kobo. That 4 naira will not stand again. Is that better, please?
Yes, it is.
Also, let me extend it again. Let me extend the explanation. Based on law of demand and supply, if you increase supply of a product, price is likely to fall. By the time you do right issue, you are issuing more shares to the stock market. Volume of shares will increase at the stock market. We expect the price to fall. All right. Cost of new share. Definitely you are going to buy this new share. Cost of new shares. You are going to buy 300 new shares at a price of how much? Let me ask. At what price are we going to buy the new shares?
3 naira 40
3 naira
kobo.
4 kobo.
40 kobo.
3 naira 40 kobo.
3.4. Now calculate cost of new shares.
1020.
020 naira.
Please, cost will be in brackets. Calculate value. Calculate quantity. 1,800 shares. Value 6,000. Look at it. Before right issue, value of the investment was 6,000. After right issue, if the shareholder decides to take up the new shares, value still remains 6,000. But number of shares will increase. Your comment here. Comment. If shareholder decides to take up his rights, his worth remains unaffected. Although number of shares will increase, although quantity of shares will increase. You have texted option 1. Please, in your exam, you are likely to have a question like this. So, I have solved for all the students. I have 3 classes, FM classes. So I try to solve the question for all the students. Yes, Rabo.
Hello, sir. Hello, sir.
Yes, sir. Good evening, sir.
Okay, I can see Rabo and up.
Yes, sir. I wanted to ask, why did we use 3 naira 40 kobo for this cost of new share?
Okay, Rabo is there. The other person can also ask, but I saw Rabo and us first. That one is very clear. Look at new shares. At a discount of 15%, new share at what price? The investor will buy new shares at a price of 3 naira 40 kobo.
That's after the discounts, right? Yes, that's true.
Is that better, please?
Okay. Yes, sir. Yes, sir. Better now.
Now, James.
Okay, sir. Good evening, sir. Please, can you move to where you were before you came to this place?
All right. Yeah.
Okay, sir. I want to ask, why did you use this existing share? You used 3.9 and the new share 3.9. Why, sir?
All right. First is, let us understand the meaning of theoretical expiry price. We said theoretical expiry price, the expected share price after the completion of the rights issue. Our theoretical strike price, what we expect the share price to be after we have completed the rights issue. We have existing shares. The price is 4 naira. We have new shares. The price is 3 naira 40 kobo. After we have completed right issue, both the new shares and existing share will be combined as one. They will now have a common price. So if you are to calculate value of existing shares after right issue, the price becomes 3.90 kobo. Is that better, Jane? How that is better, please. We have a lot to do.
Okay, sir. Thank you.
Sorry, I had a temporary network glitch. Please, can you confirm you can hear me? And you
Yes,
can
sir.
see my screen?
We can
We
hear
can hear
you.
you, sir.
Can hear you. You can see your
Can see the
screen.
screen.
All right, option 2. The shareholder can decide to reject the rights and sell the new shares to another and sell to another investor. Now, if the shareholder decides this, what is the impact on his words? Your item, quantity, price, and value. Yes. You will only please note, you are going to start with existing shares. Because that share, you have it before. That shares is already with you. 1,500. After right issue, the price becomes 3.90 kobo. Value 5850. Now we are not buying the new shares. We are rejecting and selling. What is the gain on sales? Gain on sale. If you sell your new share, what is the gain you are going to make per unit sold? Yes. You now sell the shares. What is the profit per new share? Any idea? Of the right per new share. Look at it here. Value of the right per new share. For every new share sold, you are going to make a profit of 50 kobo. You can buy the new share for 3.40 kobo. You can sell for 3.90 kobo. You are going to make a profit of 50 kobo share. By new share. Yes, Matthew.
I just want to
Gain
contribute to
on
what you're
sales.
saying.
For every new share sold, we are going to get a gain of 0.5. We are going to buy the new share for 3 naira. We are going to sell for. Sorry, I think the network is really unstable. But we can't stop the class because the time is not. We can't pause the time for moving. All right. So if you are dealing with the option 2, the shareholder will sell at a profit of. The shareholder will sell at a profit of 50 kobo per share. Assuming you are the shareholder, giving the right to buy for 3 naira 40 kobo. You are not willing to buy. You just take the instrument and sell at a profit of 50 kobo per share. That means you are going to make a profit of 150.
150.
Total quantity 15. Amount here 6,000. What has happened to the investment value after right issue?
In the same.
It remains the same.
That's gone again. Okay.
The weight of this shareholder, hear me?
Please, I'll move your screen. We cannot see what you're writing.
Hello? But can you hear me?
Yes, we can
We
hear you.
can hear you.
Yes, we can hear you, sir. We can hear you.
We
Shift
can
the
hear
page.
you, sir.
Shift the page up of the
Yes,
right up.
gone. Oh.
The right up, please take it up.
Hello, can you hear me?
We can hear you, sir.
I think his own network is also breaking out.
The weight of this shareholder will remain but it's already up now.
You can continue,
Yes,
sir. We can hear you.
You can continue. We can hear you.
The same if the new shares to another investor. All right. You must be able to hear me and see my
Sir, please come again. What did you say?
You're not writing anything, no. I don't know. Maybe I'm the only one. But the weight of this shareholder will remain.
It's all right. Now, network.
Faster than what?
shareholder can buy I finished writing self. but it has not. Okay, can you see it now? Can you see it, please?
Yes.
Yes, yes, sir.
All right. Option 3. The shareholder can sell some. The shareholder can buy some of the new shares and sell some of the new shares. What is the impact of this decision? So the question is, out of 300 new shares, assuming you are the shareholder, how many will you buy? How many will you sell? Hello?
Buy 150, say 150, sir.
Okay, 50%. Yes, Matthew.
Same. Buy 150, sell 150.
Buy 150, sell 150. Any opinion to the contrary?
Buy more and sell less. 200, 100.
Yeah, Matthew.
Sir, in exam condition, in this case,
All right.
are we to use our
Reasoning decide to
discretion or
differ.
the examiner will tell us what to buy and what to sell?
It's an assumption now. You have to bring out your assumption now.
Examiner will not tell you. This question was tested. In fact, go and check your study. Go and check ICAN Park FM. He was placed in your FM pack. This question, I lifted it from your FM ICAN Park. Examiner will not tell you how many to buy, how many to sell. You are going to decide. But the question is, or the rule is, whether you like buy 50-50, buy 50%, sell 50%. If you like just to buy, you are going to get the same answer. Evening said, I'll buy 200. And sell 100. Matthew said, no, I'll buy 150 and sell 150. Regardless of the percentage you are buying and the percentage you are selling, you are going to get the same value, the same answer. So I can come here. Existing shares will not change. 1,500. After right issue, new shares, 150 new shares. New shares taken up 150. After right issue, price of new share is 3 naira 90 kobo. Please multiply. New shares.
Hello, sir. How did you
taking
get
up.
that new shares 150?
Taking up.
585.
No, we say this.
Five, eight, five.
585. Please, no, we say this. Thank you. We say, look at the edge. Shareholders can buy some of the shares and say so. Out of 300, you are at liberty to decide how many you want to buy, how many you want to sell. We now decide. Yes, Emeka, are you ready now? Can we hear you speak?
I was asking, sir. Good evening, sir. I was asking how you got down 150 under the new shares.
I've explained this. This is like third time I'm explaining this. You know, you have 300 new shares. And alternative 3 says you can buy some of the new shares and sell some of the new shares. Now ask yourself, Emeka is gone.
I'm not gone. I'm active, sir.
Emeka, you out. Oh, he's there. Oh, sorry. Out of this new share, you are going to decide how many you want to buy, how many you want to sell. In this class, we have decided 50-50. Out of the new 150 new shares, then we are going to sell 150. Is that better, please?
Yes, sir. Thank you very much.
Now, don't forget, you are taking up new shares 150. That means you are going to buy it. What is the cost of new share? Cost of new shares taking up. You are going to take up 150 new shares at a cost of 3 naira 40 kobo. Please calculate.
510.
Cost of new shares.
510. 510.
50. What is the gain on sales? We are going to sell 150 new shares. And the gain is 50 kobo per share. For new shares sold, we are going to get a profit of 50 kobo multiplied by 0.5. Yeah. What do you have here? 75.
75.
Please sum up the value. Sum up the value.
6,000. 6,000. The value is 6,000.
Number of shares 1,650. Weight of the shareholder remains unchanged. You can put the comments. Shareholders' weight. Shareholders' weight remains unchanged. If you buy some and sell some, you can complete it. Then option 4. Please, I beg you guys, carefully study this. I just feel that examiner is likely to take 20 marks per year. I may be wrong, though. Option 4, shareholder can ignore the rights and take no action and take no action. You are not even looking at the right at all. What is the impact of this decision? You have your item, you have your quantity, you have your price, you have value. That means you are only left with existing shares. You are not doing anything to the new. We have completed the right issue. Price per share is expected to be 3 naira 90 kobo. Value is 5,850. What has happened to the investors' wealth here?
It's reduced.
It reduced. It
Thank
fell.
you. Investor will suffer reduction in wealth if it decides to ignore the rights. Those are the four options. You are done with requirement B. So please, let us create time to watch this. Now, requirement C. Calculate the current earnings per share and the revised earnings per share. If the right issue fund are used to redeem some of the existing debentures, please let me take water. Let's continue with the class. Although this question is from ratio analysis, earnings per share, examiner can choose to introduce it to any question. Now, what is earnings per share? How do we calculate earnings per share?
Divided by number of shares.
That's great, that's fine. Our earnings per share is profit attributed ordinary issue.
Oh, so we can't hear you.
It's a measure of company's performance.
Please kindly come again. We can't hear you.
Dividends.
To do a strong thing today. Wow.
Yes, Roots. Or money.
Okay, sir, please, I just want to draw you back because the network didn't permit us to hear you clearly for the any special.
Okay, the earnings per share. Your earnings per share is the amount of profits attributable to each ordinary share. Amount of profits attributable to each ordinary share. And is calculated as your profit after tax minus preference dividends. Then
Sir, you are
divide
not
it by number of ordinary shares. Any problem, please?
you are not seeing your board. You
Yes,
are not
sir.
writing anything.
It's
I'm
not
not
like
writing, I'm only explaining. I'm only explaining anything. I'm not asked to write it. I'm told to calculate. I'm only explaining before calculation. That if I want to calculate any per share, normally, let me do like this. Your EPS, profit after tax, minus preference dividends, divided by number of ordinary shares. That will give you your preference, any per share. But in this question, we don't know the profit after tax. In this question, there's no preference shares. That's even minor. We don't know the profit after tax. That means I cannot adopt this formula here. Examiner gave us in the question price earning ratio. Examiner says price slash earning ratio equals 15.24. We now pick that. Oh. Our price slash earnings ratio is 15.24. that is market price per share divided by earnings per share is equal to 15.24. Yes, voter.
Sir, I will not lie to you. This any per share, right from the beginning, I did not understand. Sorry for drawing you back.
I'm not even going back, Seth. When we get to the topic proper, when we get to ratio analysis.
Okay, noted, sir.
So you now pick your price earning ratio. Ratio of market price to earnings. Examiner says 15.24. And we know the market price per share. Current market price per share is 4 naira. EPS, we don't know. Examiner says calculate current EPS. Current market price is 4 naira. Market price over earnings per share is equal to 15.24. What is EPS, please? If we cannot take the usual approach, go and look at alternative approach the examiner has given you the question. I will now cross multiply. EPS multiplied by 15.24 is equal to 4 naira. Divide both sides by what? Divide here by 15.24. Divide here by 15.24. Cancel out, cancel out. Our EPS is equal to 0.2625. That is the current earnings per share. Currently, before the rights issue, earnings per share is 0.2625.
Are we still here?
We are still here. Have we left the class?
I was not hearing it again. So
I just at times when the lecturer pause, you want students to process certain things. That okay, this is the usual rounds. Look at the usual routes. I could have calculated EPS like this. But because in this question, I'm not giving the profit after tax, I can't use this approach. And now return back to the question. What can I see in the question that can help me to calculate EPS. I now saw that in the question. I'm giving price earning ratio. Ratio of market price to earnings. I can now use this ratio to derive my earnings per share. So a lecturer pause is to allow the student to try to rationalize certain things. Even though they are students, they can think that, okay, they can reason certain things out. Human being by our nature, we can think, we can reason certain things out. Along the line, some students will get that, oh, this is what he's trying to do. Some might not get it, so let's be factual. Our rate of learning differs. It's not, it's just, that's nature for us. In fact, some are so blessed with some topic. After I say it, just okay, this is what he say. All right. We have resolved part of the problem. A minor part now. If you go back to that requirement C, let's go back to it. Look at it. Calculate the current earnings per share. We have done that. The current earnings per share is 0.2625. And the revised earnings per share, revised earnings per share. If the right issue fund are used to redeem some of the existing debentures, how do we go about it now? Let us process the requirements. I want to know the revised earnings per share. That is, if the right issue fund, that means we have done right issue. We have generated money. We have used this money to repay our existing debt. Examiner is asking me to calculate earnings per share. After we have completed right issue, we have generated the money, we have used the money to redeem some of our existing debentures. In that case, I want to know profit after tax, after right issue. What is the profit after tax? After the right issue has been completed and the money has been used to redeem existing debt. Return to your calculation. Look at it too. Calculation of profits after tax. Right issue. Right issue funds are used to redeem some existing debentures. Debentures. Remember we said earnings per share is calculated as profit after tax minus earning. In this question, there is no preference dividend. Preference dividend is 0. Preference dividends divided by number of ordinary shares. And we said currently, earnings per share is 0.2625. Oh, wow. 2625 is equal to profit after tax. Preference dividend is nil. Number of ordinary shares currently, we have 8 million shares. If you take calculation 1, total number of existing shares, 8 million. I can get profit after tax now. If I cross multiply, my profit after tax, 8 million multiplied by 0.2625. That is my current profit after tax. What do we have, please?
2.1 million.
2.120. 2,120,000.
120 again.
2.1, not 2.1.
2.1 million naira rand. That means currently, our profit after tax is 2.1 million naira. Currently, before right issue. Before the right issue. Our profit after tax is 2,100,000. Now, after right issue, how much are we going to generate from the right issue? What is the funds raised? Yes? Any idea? How much are we going to generate from this right issue?
$3.4 times number of shares.
Lukman, what are you saying?
I said that would be price of the right issue
then multiply by the number of shares we issue.
We have calculated before.
5,440,000.
I want to know the extent to which we are following the class. We have calculated this before. Look at it here. New shares. We are going to issue 1.6 million new shares at a price of 3 naira 40 kobo. We are going to generate 5,440,000. Hello, are you there, please? Value of new shares. Total value of new shares. You are going to issue 1.6 million new shares at a price of 3 naira 40 kobo. How much are you going to generate?
5,440,000.
That was why I said this second approach, you might require it as subsequent calculation. We are going to generate 5,440,000. Now, what are we going to do with this money? Right issue. You are issuing new shares, additional fund. What are we going to do with this money?
We are going to use it to redeem some of the existing debentures.
Thank you. Go back to the question. There are two things we are going to do. Look at the starting point here. James Obasi, a medium-sized manufacturing firm making drums, is considering a 1 for 5 right issue at a discount of 15% to the current market price of 4 naira per share. Issue cost are expected to be 2 million. And this will be paid out from the funds raised. The funds raised is 5,440,000. Out of this money, we are going to settle issue cost. Then we are left with 3,440,000. Examiner says, it is proposed that the right issue funds raised will be used to redeem some of the existing debentures at par. So let's go to this treatment. Which aspects will affect our profits? I'm now tired though. First, gross funds raised. That is amount generated. We generated 5,440,000. Then gross fund. Issue cost. Amount 2 million. Out of money generated, we are going to settle issue cost. We are left with 3,440,000. This amount will be used to repay your debt. Now, let's ask ourselves, if you redeem your debt, if you repay your debt, or some of your debt, what will happen to your interest cost?
It will reduce.
The interest cost will reduce. Great. Your interest cost will affect your income statement. Now, if your interest cost reduces, what will happen to your profit?
It will shoot up.
It will increase.
Your profit will reduce.
Will increase.
Your profit will reduce.
It will reduce now.
Your profit will reduce because you are
If
paying more
interest
interest.
costs reduce, the profit will increase. So you are not
If
paying.
interest costs reduce,
you are earning,
yes, profit will increase.
All right, please. If you reduce your interest payments, what happened to your profit?
It will shoot up. It will increase.
It will increase, sir.
It will increase.
Use the word increase. Your profit will increase, not reduce. If your interest payment reduces, your profit is going to increase. All right? If your profit increases, what happens to your tax liability?
Tax liability will increase.
It will increase.
Your tax liability will increase. These two items, interest payments and tax liability, will affect your profit after tax. The actual loan will not affect, your profit directly. By repaying your loan, by repaying 3,440,000, that means interest will not be paid again on the amount you have repaid. For example, you took a loan of 5 million from the bank. You now repay 3.5 million. That means that 3.5 million repaid, interest will not be paid again on the amount you have repaid. In that case, we have interest saved. Interest saved. What is the interest on the bond? 12%. Compute 12% of 3,440,000. That will give you 412,800.
800.
That is called interest saved. On this amount, you are not going to pay interest again. Technically, your profit will increase by 412,800. If your profit increases, you are going to pay tax on that increment. Tax liability, 30%. 30% of 412,800. Please compute.
123,840.
840. You can now calculate revised profit after tax. Look at the addition. 2.1 plus 412,800 minus 123,840. We're almost done. What can we do? Please, can I have the figure? If you have it. Please don't add 5 million. No. We're only adding 3 things. Items of income statements. I hope you can hear me, please.
Yes, sir.
You are going to add 2.1 million.
388,960.
It's 960. You have gotten your revised profit after tax. When we say revised, after we have done right issue, we have generated the money, we have repaid our existing debentures. What is the profit after tax? 2,388,960. Now, revised number of ordinary shares. Revised number of ordinary shares. After right issue, how many shares do we have in this company?
9,600,000.
It was 8 million, 9,600,000 revised.
Thank you. After right issue, we have 9 million. 9,600,000. You can now calculate revised earnings per share. Revised EPS is equal to revised profit after tax divided by revised number of ordinary shares. In that case, I'm coming, please, Ruth. Is equal to 2,388,960 divided by, let's calculate. Your question, yes, Ruth.
0.24885.
Okay, sir. My question: how did we get the revised number of ordinary shares 9,600,000? I thought it was 8 million.
All right, that was existing number of shares. Let me pick this first. 0.2489.
Yeah.
Now let me answer on money. Before we have 8 million, we now issue 1.6 million new shares. 8 million plus 1.6. What do we have, please? Ruth, are you there?
Yes, I'm here. 9.6 million.
That was why we say that is when we say revised, after we have done the right issue. Yes, the Zoom user.
Yes, sir. Hello, sir. Please, how did we get the tax liability of 30%, sir? Well, are we giving in the question?
Yes, ma.
Okay, thank you.
Examiner say tax rates.
Okay.
So let's quickly go there. Yeah, this is income tax rates. 30%.
Okay, sir. Since, sir. Thank you.
The question was texted professional level. The examiner has given it to your slab, to your this thing. Study pack. It's in your study pack. All right. Any question, please? We are done with the question. But let me ask you, assuming you are asked, this question now, do you think shareholder will be happy with these arrangements? Issuing new shares to repay existing debt. Is this decision favorable to shareholders? Let me hear your view. Would the shareholder be happy with this decision? You are raising additional debt. Sorry, you are raising additional shares to repay existing debt.
No, they won't be happy.
They won't be happy. Why?
The earnings has dropped.
It is when they make profit that shareholders are being paid their dividends also. I
Okay.
don't think since the
But
profit has been used to
that's
offset part of
the
dividend.
supporting point is not correct. They will not be happy because earnings per share has fallen. Before, earnings per share was 0.2625. After the right issue and redemption of debt, earnings per share has fallen to 0.24889. That means technically the earnings has fallen.
Okay.
The proposal to use right issue fund to redeem existing debt may not be the best option. Assuming you are asked to explain, that proposal will not be acceptable because it leads to reduction in earnings per share. A reduction in earnings per share will lead to reduction in dividend per share. I only brought that in. We are done with this question. Please, when you get the material, this question, solution is here. For this question, you can check the solution. It will also help you because our next class, we are going to the next topic. We have spent time on this topic, like 3 weeks now. May God give us a better understanding. Any question, clarification? I will be checking out.
Hello, sir.
Yes, please.
Please, are you sharing the material now? I was locked out from the class. I just joined back.
What do you say, sir?
I said I was logged off. My network threw me out. So, are you sharing the material now, please?
Normally, we don't delay material now.
Okay, sir.
If they are used to the class, as soon as we are done with the class, material is sent to the group. So, and you will have gone to sleep.
Sir.
When we finish now, all of us will go to bed. But we can't go to bed. We have to share the material first.
All right, sir. Thank you.
Let's have a blessed evening.